Do I have to pay tax on stocks if I sell and reinvest? Earning returns is the primary motivation for investing in stocks. Investors may also seek income through dividends, among other goals, but typically buy stocks hoping the value will increase. Early investors in successful businesses can gain substantially by buying stock and selling it when the share price is high. Naturally, the federal government and some states also want to receive a portion of the gain through income tax. The difference between what you pay for a stock and what you sell it for is a capital gain. The type of capital gain and the tax rate depends on how long you own the stock. Suppose you buy 100 XYZ shares for $10 each and keep them for 2 years. At that time, the shares are worth $20 each, so you sell them all for a profit of $1,000. Since you have held the stock for over a year, you will pay capital gains taxes at the lower long-term rate. If you sold the stock within the first year, you would pay short-term capital gains rates, which are equal to your ordinary income tax rate. In either case, your overall income also influences the amount you pay. Still, long-term capital gains rates are no higher than 20%, while ordinary income and short-term capital gains rates can be as high as 37%. What happens if I also lose money selling stock? You incur a capital loss if you sell stock for less than you paid. While no taxes are applied to losses, you can leverage the loss to offset gains. For example, if you lose $1,000 on stock A and gain $1,000 selling stock B, the gain and loss balance each other and eliminate the taxes you would owe on the gain. What if I reinvest the proceeds? Buying additional stock shares with the proceeds from a stock sale will not eliminate or reduce capital gains taxes. However, if you reinvest the gain into a qualified opportunity fund, often called a QOF, you can defer the payment of capital gains taxes while you are invested in an eligible fund. QOF investments are part of the Opportunity Zone program Congress created when it passed the Tax Cuts and Jobs Act in 2017. The program's details are complex, and projects must meet numerous requirements to maintain eligibility. Furthermore, the deferral is set to expire at the end of 2026, at which time investors would owe the deferred taxes. How do capital gains taxes work with mutual funds? If you hold shares in a mutual fund, you may owe capital gains taxes when the fund sells its holdings and distributes the return to the investors. In most cases, the investor can keep or reinvest the income in more mutual fund shares. In either case, the investor will owe long-term capital gains taxes on the distribution. If you sell your mutual fund shares for a profit, you will owe taxes on that gain. The applicable rate depends on how long you have held the mutual fund shares. Of course, if the mutual fund is held in a qualified retirement account, the participant should not need to pay taxes on this income. Instead, they will pay taxes on account withdrawals. Do I pay taxes if I don't sell? You have unrealized gains if you own stock valued at more than your basis. You do not owe taxes on unrealized gains. Instead, you pay taxes when you realize gains by selling stock. In some cases, investors may prefer to borrow money using the stock portfolio as collateral rather than obtain cash by selling. The effectiveness of this approach depends in part on the interest rate for the loan. The exception to this scenario is regarding gains generated from your mutual fund holdings, as previously discussed. Let Realized build you a passive, diversified portfolio designed with minimal uncertainty while avoiding as much capital, income, and estate taxes as possible. To learn more or book a consultation, check the links in this video's description.